The Federal Reserve prints money, trillions, created not in factories, not in vaults, but in silence, with a few quiet keystrokes. Numbers become dollars, dollars become debt. And somewhere in that transformation lies a truth almost nobody ever asks: if every country is drowning in debt, who's the lender? Because every dollar has a secret. Every secret has a cost. And this is the debt no one sees. As Finny used to say, the greatest trick in finance. Convincing us money is free. To understand it, we have to go back 113 years to 1913. A cold December, Woodrow Wilson signs the Federal Reserve Act. America believes it's building stability after decades of crashes and panics. But what emerged wasn't a normal institution. Part government, part private, part guardian, part puppeteer. And most people still don't know what it actually does. See, the Fed doesn't print physical money. That's the Treasury. The Fed creates money the modern way. It types it. The moment it buys a government bond, new dollars appear, created out of thin digital air, attached to a promise called debt. As Finny used to say, magic isn't real unless you have a Federal Reserve Charter. Here's the part that bends people's brains. The U.S. government borrows money from investors, from banks, and from the Federal Reserve itself. The government sells a treasury bond. The Fed buys that bond and pays with money it just created. Which means, in a very real sense, America is borrowing from itself. A loop, an echo, an IOU written by one hand, and paid by the same hand. It works. As long as everyone believes it works, because when belief collapses, the loop collapses with it. As Finny used to say, only governments can owe themselves money and still call it stability. For decades there was a leash, a limit to how far this could go. Gold, every dollar once represented something physical, real, heavy, unforgiving. But then came 1971, President Richard Nixon. I have directed Secretary Connolly to suspend temporarily the convertibility of the dollar into gold. Temporarily, a word that became permanent. The gold standard vanished. The leash snapped. And suddenly, the value of money depended on one fragile ingredient: faith. Faith in the government, faith in the system, faith in the idea that as long as we all kept believing, the illusion would hold. As Finny used to joke, the dollar went from gold-backed to faith-backed, and faith's been inflating ever since. Then came 2008. The collapse, banks burning, markets falling like dominoes, the global economy on its knees, and the Fed responded the only way it could. It typed a rescue. Trillions flooded straight into the system, and the markets stood back up smiling, relieved, triumphant. But behind that miracle is a shadow. Every new dollar is someone's new debt, a debt owed to an institution that created the money. Without mining, without labor, without production. Just keystrokes, as Finny always warned. The Fed doesn't print cash, it prints obligations. And that obligation is about to reshape everything you think. You know about wealth, debt, and who really controls global money. But to really understand why every country is drowning in debt today, we need to go back to the moment the fuse was lit. A single decision that rewired the global financial system. 1971, the year money changed species, when President Nixon shut the gold window. Money stopped being anchored to anything physical. No gold bars, no vault ceilings, no hard limit. It became elastic. Governments could now create money as easily as they created debt. And central banks suddenly had the power to print away crises. As Finny used to say, the moment money left gold, it grew wings. And then it learned to multiply. Debt stopped being a burden. It became the bloodstream of the global economy. A new era began, one built on confidence, liquidity, and the quiet assumption that debt could rise forever. By the 80s, governments weren't the only ones borrowing. Corporations joined in. Consumers joined in. Banks created new instruments to sell debt-like products on a shelf. Mortgages, corporate bonds, government bonds, junk bonds, derivatives. Debt became inventory. Leverage became strategy. Growth became dependent on expansion, not savings. As interest rates fell, borrowing became irresistible. And global debt didn't just rise, it accelerated. As Finny used to say, once cheap credit shows up at the party, it never leaves voluntarily. Countries opened their borders. Capital flowed easier than ever. China entered the global market. Europe integrated deeper. Emerging economies went on borrowing sprees to modernize. Debt-connected nations like electrical wires, a spark in one place could now set the entire grid on fire. But this integration brought something else. A world where countries borrow in one currency while earning in another. The dollar became the center of the system, the axis of trust. As Finny used to say, the world doesn't run on dollars. It runs on dollar obligations. Then came 2008, the global financial crisis. The world's credit engine seized, banks collapsed, markets froze, economies stalled, like a plane losing all engines at once. Debt had grown faster than the system that supported it. But instead of letting it collapse, central banks stepped in with a new kind of power: quantitative easing, zero interest rates, emergency lending facilities. They didn't repair the system, they inflated it. Governments issued debt to rescue banks. Banks bought government debt to stay alive. Central banks bought both to stabilize the system. A perfect loop, a closed circuit, as Finny used to say. In 2008, we didn't fix capitalism. We just duct-taped the debt machine and hoped it held. Fast forward to today, global debt sits above $315 trillion. That's more than 3 times global GDP. Households owe corporations, owe governments, owe banks, owe banks owe. But the system keeps moving. Why? Because debt no longer needs to be repaid in the traditional sense. It only needs to be serviced, rolled over, extended, restructured. And so long as trust holds, so long as interest keeps flowing, so long as central banks keep the pipes from freezing, the machine keeps running. As Finny used to say, modern debt isn't a bill, it's a subscription, and the world is on auto-renew. So yes, every country is in debt. But the real puzzle isn't how much we owe, it's how the system can survive owing so much. Because in a world where debt grows faster than the economy, where obligations stack higher than output, where money itself is created from the promise to repay, we arrive at the conclusion no one likes to say out loud: the global economy isn't built on wealth. It's built on agreements, on trust, on belief, on collective participation in a system that only works as long as everyone stays in the game.